On July 5, 2026, MoneyWise ran a headline that rattled the retirement market. Tapping your 401k to pay off credit card debt could cost you a lot in taxes, penalties, and lost growth. That headline isn't just a warning, it's a snapshot of a growing trend. Every day, more Americans are tempted to pull money from their employer-sponsored retirement accounts to clear high-interest credit cards. The lure is simple: a lump sum withdrawal can wipe out a debt that would otherwise accrue 15 to 25% interest over months. But as MoneyWise points out, the immediate tax bill and the long-term loss of compounding can outweigh the short-term relief. Think of a single credit card balance of $25,000 with an annual percentage rate of 22%. Over a year, that debt alone costs you $5,500 in interest. Now imagine taking $25,000 out of your 401k to eliminate that debt. Immediately you trigger a 10% early withdrawal penalty, $2,500, and you owe income tax on the full $25,000. In a 24% marginal bracket, that's another $6,000. The net out-of-pocket cost jumps to $8,500 right away, and you lose decades of potential growth that could have turned that withdrawal into a future nest egg. That's the crux of the MoneyWise headline, an urgent question for anyone balancing debt and retirement gauge. Since the MoneyWise article hit the headlines, the IRS has tightened the rules around early 401k withdrawals. In 2025, the government expanded the list of hardship exceptions, but the penalty remains unless you qualify for the exception and can prove total hardship. The 10% penalty still applies to most withdrawals before age 59.5, and the tax code treats the lump sum as ordinary income, adding it to your taxable wage for the year. Meanwhile, the federal tax brackets for 2026 see a modest rise. The 24% bracket now starts at £89,450, meaning many middle-income savers will see a larger tax hit. In addition, the average credit card APR has edged upward to 18.7% in 2026, further increasing the cost of carrying debt. These shifts mean that the easy fix of pulling from your retirement account is more expensive than ever. Let's break down the immediate cash flow hit of a 401k withdrawal. First, the 10% early withdrawal penalty. A $30,000 pull costs $3,000. That's trab, but the real sting comes from income tax. If you're in the 24% bracket, that same $30,000 adds $7,200 to your Brink tax bill. Combine the penalty and tax, and you're looking at $10,200 in out-of-pocket costs, almost a third of the money you took out. And that's only the first year. The IRS will treat the entire sum as ordinary income, which may bump your registration into a higher bracket for the rest of the year, potentially pushing your marginal rate up to 32% for the 2026 tax year. The penalty is also non-refundable unless you meet an exception, so the cost stays with you permanently. Even if you qualify for a hardship exception, the IRS requires you to prove the hardship meets specific criteria, which can be a bureaucratic hurdle. If you're a young professional, the penalty can knock you out of your early career growth trajectory, as the money you lose in the withdrawal never gets a chance to compound. Beyond the immediate cash outlay, the real horror is the loss 570 of compounding. A 401k is designed to grow tax-deferred until you retire, typically at an average annual belay of 6 to 7% over the long term. Take a $20,000 withdrawal in 2026. If it had stayed in the plan and earned 6% annually for 30 years, that $20,000 would have ballooned to roughly £300,000. By pulling it out, you permanently reduce your retirement base by that $20,000. And because returns are reinvested, the compounding effect is self-amplifying. You're not just losing the $20,000, you're losing the future earnings on that amount. For a 35-year-old, losing $20,000 could mean a reduction of around 35% in projected retirement income at 65. The math is stark. $20,000 withdrawn now equals a potential $280,000 in lost growth over 3 decades, an astronomical opportunity cost that no debt payment can justify. credit card debt itself is a real drain. In 2026, the average credit card APR sits around 18.7%, which means a £10,000 balance will cost you over £1,800 in interest in a year if you pay only the minimum. The typical minimum payment on a £10,000 balance is roughly £250 a month, taking almost 2 years to clear the debt. By contrast, a £10,000 401k withdrawal eliminates that debt instantly, but at the cost of a 10% penalty and higher taxes. If you run the numbers, a £10,000 credit card debt costs you £1,800 a year in interest. A 401k withdrawal of the same amount would cost you a £1,000 penalty plus tax, which could be around £2,400 in a higher bracket. In Crito, the immediate relief is offset by a similar or greater financial hit, and you lose the ability to grow that money tax-free. Looking ahead, the trend of early withdrawals is likely to plateau or even decline if the IRS tightens enforcement. In 2027, the Treasury is expected to introduce a new compliance tool that flags large unexpected withdrawals for audit. Moreover, financial planning firms are advising clients to use low-interest personal loans or balance transfer credit cards to chip away at debt, rather than pulling from retirement. The retirement account market is also seeing a shift. More employers are offering Roth 401k options, which allow after-tax withdrawals in retirement without penalties, reducing the temptation to use 401k as a debt repayment vehicle. If you're in the 2026 tax year, the safest path is to keep your 401k intact, use debt repayment strategies that do not trigger penalties, and take advantage of employer matching contributions that grow your retirement faster than any debt repayment plan can. In short, while the idea of pulling from your 401k to wipe out credit card debt is tempting, the numbers say otherwise. You'll face a 10% penalty, higher income tax, and the irreversible loss of decades of compounding growth. That cost often outweighs the interest you're paying on the debt, especially if you're in a higher tax bracket. Instead, consider balance transfer cards, debt repayment plans, or a small personal loan that offers lower interest without touching your retirement savings. Protect your future by keeping your 401k where it belongs, growing tax-deferred, ready for retirement. If you're unsure, consult a financial advisor who can map out a strategy that balances debt reduction with retirement security. Stay informed, occasions, and let your 401k do what it was built to do, help you retire comfortably.